All right, we are going to go ahead and get started. I will give a very brief introduction to my friend Alene. Alene is my favorite lender. I don't say that lightly. I have a lot of friends and referrals that have been good to us over the years, but in terms of customer service and everything of that nature and just expertise, Alene is a banker and a lender that I trust implicitly. She has been a rock star in the Nashville community for a very long time, to the point that she not only works with me, she works with my mother, who's a realtor as well. So I put her credentials in the invitation, so I won't spend a lot of time going over those. Alene, if you want to, you're more than welcome to. But let's just leave it at the fact that she is not just based on opinion, based on fact, one of the highest producing lenders in the Nashville area. So, Alene, thank you for joining us this evening. And as you know, our title is How to Position Yourself to Own Multiple Investment Properties. And I will turn it over to you.
Well, thank you, and welcome everyone. I'm not sure how many are on the call, but for those that are also going to be listening, just to fair warn you, this is my first podcast, so hopefully the lawnmowers won't start in the neighborhood as I begin. But thank you to Brenton for the invitation. I've worked with Brenton along with his mom, as he mentioned, who's been a realtor and a client of mine for probably 20 years. So a little bit about me. My name is Alene, and an easy way to remember how to pronounce my name is just remember that when I help you finance your first rental property, I'm going to put Alene on your house. Aha. I didn't even have to change my name to get my job. And my mom, by the way, was a realtor, so she must have had some instinct there. And my last name is Gnyp. It's Gnyp. And it kind of looks like gross national product. Throw a Y in there, and sometimes we call Y a vowel, so we'll call it a vowel today. But I'm originally from Wisconsin, if you notice a little accent, and born and raised there, and met my husband at the University of Wisconsin, Whitewater, and ended up getting married and moving to Detroit, where we purchased our first investment property, which we'll be talking about a lot today. So just to back up a little bit, I work with Synovus Bank, and for those of you on the call who are not familiar with our brand name, I'd love to share the story. It's kind of a fun one, but Synovus Bank actually started in Columbus, Georgia. It's been around 133 years, so we're a strong bank, been around here a long time. But about 25 years ago, Synovus Bank decided to kind of expand where they were outside of Georgia, came up to Nashville, found this great market called Nashville, Tennessee, and bought the Bank of. They went down to Florida, down in Destin, and bought Coastal Bank and Trust. They did this throughout Tennessee, Georgia, South Carolina, Alabama, and Florida, and ended up with about 30 different banks, 300 branches, and for the last 25 years, we've been operating under 25 different community bank names. The board of directors, teammates, employees, everyone kind of said it would be really nice if we went to one name. So in 2019, all 30 banks, 300 plus branches, all changed to the name Synovus. So the red signs went up in all 5 states. So I'm actually able to lend in Tennessee, Georgia, Alabama, South Carolina, and Florida. And if you think about those states, a lot of those states are places where probably a lot of you have vacation. So as we think about buying a investment property, also be thinking about second homes or rental vacations. Think of Gulf Shore, Alabama. Think about Panama City, Florida. Think about Destin, Florida. Think about Sevierville in the mountains. All these places make great investment properties, and you can use an investment property as a second home. So, why do you want to even buy a rental property? And people ask me this all the time. They're like, Alene, how did you get into rental properties? And what makes you stay with it? Because I've been in the business for 33 years owning rental properties. So I'd love to share my story. Would you like to hear it? Well, I can't hear the responses, so I'm going to share my story. Okay. So my story goes back to when I was just in probably grade school. My parents owned a rental property. It was a 4-family. There were 4 homes under one roof. And probably about the time I got into junior high, my parents, they call it upgraded or did what's called a 1031 exchange, which we can also talk about. That is when you sell a rental property, you don't take the proceeds, but you roll in all the profits to your next property. So about the time I was in junior high, they upgraded or did a 1031 from a 4-family to an 8-family. Now you've got 8 rental properties all under one roof. A lot of cost savings instead of owning 8 separate units. So let me tell you what would happen. Probably about midweek, my dad would say to the 4 kids at dinner, okay, who wants to make money? We're going to be cleaning out unit number 6 on Saturday and Sunday. And I'd always raise my hand because I always love making money. And I guess that's why I'm in banking. But I always loved to make the extra money, would volunteer to go on Saturday and Sunday and clean out the rental properties. I learned how to clean out a stove, intimately knew how to clean a refrigerator, the back coils. My mom was great about taking the windows apart, teaching us how to clean the screens, clean the tracks. In fact, to this day, my favorite cleaning tool is a toothbrush. Thanks, Mom. So we all learned as kids how to clean the rental property, how to paint, how to caulk. And I'm not kidding, I'm telling you, I knew how to work a caulk gun back by the time I was in 9th grade. But what I also learned was that my parents were very good with their tenants. I would watch my dad talking to the tenants. I'm not sure I always knew what they were talking about, but they always seemed to get along really good. So it kind of taught me that good rapport with your tenants was an important component to owning rental property. Now I'm going to switch over to my husband, Andy. Well, growing up, they had 5 kids. 3 boys, all 1 year apart. Well, his dad didn't give him the option, according to Andy. He would say, boys, the next 3 weekends, we're going to be scraping and painting the duplex. And guess what? They owned a rental property in their family as well. And he learned on the weekends it was a nice way to make money cleaning the rental property or painting. So when Andy and I got married and moved to Detroit, again, this is kind of part of my story and how I got in, is when we got married, we actually got money for our wedding, and we decided not to blow it on a cruise, not to blow it going on a trip across the country, which some of our friends had done, but instead we took a 2-day quick little trip to Niagara Falls to celebrate our wedding, came back, moved in with his parents, lots of fun after you've just been married, and decided that we wanted to buy our first rental property. So we got with his parents, talked to them, met a realtor, and off we went to buy our first rental property at age 23, and we bought a duplex. Now, a duplex is a 2-family. In Detroit, they were primarily an upstairs and a downstairs. I've noticed in Tennessee and Georgia, they're more likely to be a side-by-side, almost look like a townhouse. But we bought our first duplex. And let me tell you, the best part was we closed, and back then it took about 90 days to close on a rental property. In today's environment, typically it's about 30 days. So you can become a landlord, start collecting those rents pretty darn quick. But back then it took about 90 days. The best part was as I made the first mortgage payment, I was collecting rent from the tenants upstairs, and it didn't cost me any money out of pocket. The entire rent covered the mortgage payment and part of our utilities. And then kind of the light bulb went out. That's why our parents had rental properties. It's great cash flow. Let's talk a little bit about how much money you'll actually need to purchase a rental property. Looking at most of we call them investors. These are people that you would do a loan with me at Synovus, but we would actually sell the mortgage to maybe Fannie Mae or Freddie Mac. They are pretty consistently across the board, all requiring 20% down payment for a rental property. And this would be for a loan up to $510,400. For this purpose, we're just going to say 510. It's a little bit easier. They always come up with these odd amounts, but we're going to use 510,000. So as long as you buy and your loan is up to 510, you're going to need a 20% down payment. Now, if you go over a loan amount of 510,000, then it's considered a jumbo loan, and those investors are typically requiring 25% down payment. So you have to save up a little bit more. Guess would be for most of you, including myself, buying the first couple rental properties, it's going to be well under that 510. Okay. So, the best way to kind of think about purchasing a rental property is I highly recommend that you get pre-approved. And for those of you on the call that already own a home, I'm sure you did this when you bought your first home. You didn't just walk into a $500,000 house and hope that you qualified. You probably talked to a lender. So we offer what are called free pre-approvals. And that allows us as a lender to look at three things. One, your income. How much do you make on a monthly basis? What does your credit look like? You have to have good credit to buy a rental property. And three, how much money do you have available to purchase a home? If we look at your loan application and you only have 10% down but have super great credit, we're probably going to talk about a strategy for saving up more money so that you hit the 20% mark. Working with Brenton, I'm sure he can help you with the savings plan. And there are going to be different ways to build up your savings quicker than others. Let's talk about a few ways that we call them allowable sources of down payment, okay? Allowable down payments can come from a variety of places. And then we're also going to talk about places that you cannot pull money for your down payment. So places that are allowable for down payment. One, it can be money from your own savings account and checking account, money market accounts, investment accounts, of course. Money can also be borrowed through your 401k plan. So this would be a retirement plan offered through your employer. Typically, employers will allow you to borrow up to 50% of the balance in your account. So for those of you on the call that have been working for 5 or 10 years, you may already have $100,000 saved up in your 401k account. Talk to your employer, we call them the administrator of the plan, and you may be able to borrow up to 50%. That would give you, if you have $100,000, allow you to borrow $50,000. The way that you pay that money back is directly from auto deduct from your paycheck. We do not, as a lender, count that debt into income ratio. So, and that's true also when you buy your primary residence. So that's a great way to kind of really have a loan for your down payment, but it not count as a debt. If you work for a nonprofit, i.e. like a Vanderbilt, they have what is called a 403B plan. Typically, those employers do not allow you to borrow through that plan, at least the last time I checked. Another allowable source is if you own your primary residence and you have some equity in the house, you could borrow against the equity in your home. For example, there is something called a HELOC. The acronym is HELOC, stands for Home Equity Line of Credit. That is a second mortgage that the lender puts on your home. So for example, let's say that your house is worth, I'm going to use real easy numbers, $100,000 is the value of your home. We would typically multiply that times 90% or $90,000, subtract the balance on your first mortgage. Let's say you have a $50,000 balance on your home. That would then allow you to borrow the difference between that 90% number, which was $90,000, and the $50,000 that you own, or $40,000. The bank would then give you a line of credit. Think of it kind of like a credit card. But they would usually give you a book of checks. You can call to do a transfer, but now you have a $40,000 line of credit that is totally allowable to use for your down payment on your investment property. And this is how a lot of my clients purchase their first or second property. Keep in mind, if you're in an area where home values are continuing to go up, you can also apply for an increase on your HELOC a couple of years after you acquire it. So as the home goes from $100,000 in value, let's say up to $200,000, you can go to your lender and apply for an increase of your HELOC. Isn't that nice? So as the equity builds up in your home, you can tap into that. And typically that line of credit is available to you for 10 years. At the end of 10 years, you usually have to close it out and start with a new one. Another way to pull cash out of your home is to do what we call a refinance with cash out, or for short, refi cash out. In fact, right now I have quite a few clients that are doing refi cash out to consolidate debt. A great purpose is to pull the cash out and you can use that money for the down payment on your rental property. The way that those loans work, again, I'm going to use the 100,000 because it's just an easy number to work with. So let's say your house appraises for 100,000. Typically, equity lines allow you to go up to the refi cash out up to 80%. So 100,000 times 80% is $80,000 minus the mortgage that you owe. Let's say it's 50,000. That then gives you a $30,000 cash out. So the lender would put a brand new mortgage on your house for $80,000. We would pay off the 50,000 that you owe and give you cash out at closing. So now you got $30,000 and you're allowed to use that money for any purpose you want. You can use it to buy a rental property. Okay, so that's a few allowable ways to kind of come up with your down payment. Another way would be, I'm going to talk about the disallowable ways. So I get customers all the time that say, my parents are going to give me a gift. Well, unfortunately, once you get to buying your first rental property or your second or your third, you can no longer get a gift from mom and dad or your grandparents, okay? Money's got to come from your own account or the sources we talked about. So down payment money cannot be gifted. You can also not get money from the seller. So the seller is not allowed to inflate the sales price and give you cash back to help fund your down payment. The seller is allowed to contribute towards your closing costs. And the limit for almost every loan program out there is 2% of the sales price. So if your rental property that you're purchasing is $300,000, you can negotiate, just like you would, let's say, when you were buying your primary residence. Maybe you didn't have a lot of money purchasing your first home, barely scraped together the 5% for your down payment, and you needed $8,000 for closing costs, and your realtor said, let's ask the seller to contribute or pay that. It is also allowed when you buy your rental property. And the limit has been 2% for many, many years. So again, if the sales price is $300,000, multiply that times 2%, 3 times 2, you can have the seller contribute or pay $6,000 towards your closing costs and prepaids. Totally allowable. Those should give you a couple, ways you can and can't finance the down payment. Okay. We talked a little bit about loan limits, and every year the loan limit for what we consider a non-jumbo changes. Having been in this business now for 26 years, I think it started off around 200,000 and now it's at 510,400. So what that basically means is that conforming loan amounts, I use the term with my clients non-jumbo, just a lot easier term to remember. So a non-jumbo loan is a loan up to 510,000. And for that loan size, typically you only need 20% down payment for an investment property. Okay, so let's talk a little bit about the number of properties that you can finance. Most people say, oh, the sky's the limit. I know people who own 50 properties, and that probably is true. But when you're getting a mortgage, lenders actually have a limit as to the number of finance properties you can obtain. Now, I'm not saying that you couldn't find a lender that could do more, but you would probably have to do a lot more calling because most lenders are going to limit it to 10. So the limit is 10 finance properties when you're in the non-jumbo arena. So how does that really work? Let's say that you own your primary residence and you have 8 other rental properties that all have mortgages. You have a total of 9 finance properties, right? Your primary plus 8 is 9 finance properties. You have room to get 1 more mortgage for your 10th finance property, okay? Now, this does not mean that you can stop buying at 10. Like I said, there will be a lender out there, I'm sure there is. When I was trying to finance our 11th property, we had to do a lot of extra calling around. Actually, maybe you would call, credit union. It may be a private loan that somebody holds back. Sometimes a seller will hold the loan, which I've done some of those in the past. But once you get to the 10, and you may just say, 10's enough for me, I don't really want any more. But you might also start working towards paying off the mortgages. So after a certain number of years, you might have 10 finance properties, but maybe you've worked towards paying off 5 of those loans. And now you only have 5 finance properties. So now you own 10 properties, but you only owe or have mortgages on 5. You can now get 5 more mortgages. So all you have to remember, the rule is you can own 100 properties, you just can't have more than 10 finance properties. That rule kind of goes out once you're buying your primary residence, which is a good rule. So if you were coming in and said, you've got 10 mortgages on 10 rental properties, but you came in to talk to me about buying your 11th property, but it was going to be your primary residence, that rule is not applicable for most loan programs. Okay, so that's a little bit about the maximum number of finance properties. Let's talk a little bit about credit and what your credit score needs to look like when you're buying investment property. When you're applying for an investment property loan and you have less than 6 finance properties, typically the minimum credit score required is a 680. Now, as this COVID virus has been going on, I've been getting daily emails about how the investors are increasing the minimum credit scores. Talking today with our head of credit at Synovus, they think this is a temporary adjustment until we kind of work through this. But for the most part, as long as you have a 680 or higher, you can typically get financing on an investment property. Once you have more than 6 properties financed, your credit score needs to be up a little bit higher. Some investors are looking for 720 to 740. So maintaining your credit is super important, especially as you are looking to buy investment properties. And this is probably a good time to let you know what impacts your credit. I have borrowers that I'll talk to that may have talked to another lender and already had their credit report pulled, and then they get my name and they say, I really want to talk to you. I know you've been doing this for a long time, and they're like, but I just don't want you to pull credit. And I let them know that an inquiry, so when a lender pulls your credit, it's called an inquiry. An inquiry has the least impact on your credit score. So what I'd like to do is share with you now what has the worst impact. So the worst things you can do to impact your credit in a negative way, number 1 is a foreclosure. That's when the house is taken back by the bank for non-payment. Next one is going to be a bankruptcy. Regardless of whether it's one or the other type of bankruptcy, they're both not good for your credit report and can take sometimes up to 7 years before you can actually get a new mortgage. The next one is going to be a mortgage late payment. Oh, that is taboo. You do not want to be late on a mortgage payment. So once you have missed a mortgage payment, you are now ineligible for buying a house, your primary residence, or getting a rental property loan for 12 months. Once you've had a late payment, you've got to wait until month 13 before you purchase, or you can pay cash, but before you are eligible for a mortgage. And that's true even on a refinance, which is really sad because sometimes people have an oopsie and they miss a payment, and now they're trying to refinance because the rates are 1% lower than they were maybe 2 years ago. But if they have a mortgage late on there, they've got to wait till month 13. So please, please, no matter what you do, keep your mortgage payments paid on time. The best way to make sure that happens is to sign up for automatic draft on your mortgage. And I do automatic draft on all my rentals. We're all so busy, and all it takes is one slip up to miss one payment, and it ruins your credit. So then the next thing in line would be a late car note or any installment loan. A student loan late payment is just as bad as a car loan being late, or a car lease payment. Next in line is going to be a credit card payment that's been missed, and a collection. Actually, a collection is actually going to be almost underneath a bankruptcy. And the collection could be for $100, and it is horrible on the credit report. So really make sure that you pay your bills on time, especially if you're looking to buy not just a primary residence, but your rental property. You've got to maintain good credit. Let's talk a little bit about when you apply for the loan, whether you're applying on your own or let's say you're applying jointly with a spouse, okay? When we pull credit, we're pulling from all those 3 bureaus we just talked about. we're going to throw out your high score and your low score, and I'm going to use your middle score. Then I'm going to do the same thing for your spouse. Pull their it's called a tri-merged report. I'm going to throw out the high score and the low score. And now I'm going to count, or I'm going to use for your mortgage, the lower of the two middle credit scores. Okay? So if I need both income sources, I need a husband and a wife to qualify for the rental property, but one has some dings, like they missed a car note or they were late on a student loan payment, and that score is now below a 680, I may not be able to put that person on the loan, and now I'm only counting one borrower's income, and they may not qualify for the rental property. So that's always another good reason to order a copy of your credit report. Take a look at it, see what's on there. And you may even want to consider getting pre-approved, where we pull a tri-merge way prior to you thinking about buying. So if you're saying, well, I don't have enough money now saved up, but I probably will in about 6 to 9 months, give me a call. We can pull credit. We do have to do a loan application, pull a tri-merge credit report for you and review that with you and say, you're in good shape. Your credit's good. All you need to do is save up another $18,000 and you're ready to buy your first rental, okay? And the last thing I want to mention, we talked about, I had a borrower just the other day who said, oh, I already talked to another lender. They pre-approved me. I really don't want you to pull my credit score. It's going to ding my credit. I hear that all the time. So the credit bureau does a kind of a neat thing, and they call it batching your inquiries. So when you apply for a car loan and you go to 4 car dealerships all within a week, they actually combine all those inquiries into one. So if you're applying for a mortgage and getting pre-approved with more than one lender, we also batch all those inquiries as one. So you're not going to apply for a credit with lender number 1 and it go from an 800 to a 750. Typically an inquiry might take a few points off. It might go from 800 to maybe a 795. And then if I pull it on the second lender, it should have very little impact off that 795. Let's transition over to what lenders call DTI. It's one of our famous things we talk about when we're getting ready to approve your loan or underwrite your loan. DTI stands for debt to income. And debt to income is a real simple formula. In fact, you could, if you got a pen on and you got a calculator, you could do this formula along with me. So do you remember when you bought your primary residence, how your lender said, oh, we have 2 DTIs, we have 2 debt ratios. One is your housing ratio DTI, and the second one is a total debt ratio. And let me explain. Your housing ratio should be not more than about 33%, or we say a third of your monthly gross income. So let's use an example of a borrower who has a $10,000 monthly gross income. Remember, gross is before taxes are taken out. That's the big number on your paycheck. Then typically for a house payment, we multiply that times 33%. And that rule has been around for years and years. You may have had your parents tell you this. Oh, your house payment should never be more than a third of your income. And you know what? That rule is still in place today. Now that rule applies when you're buying your primary residence. But we're talking about now buying your rental property. So we need to talk about your total DTI, total debt to income. So now we're going to take that $10,000 monthly gross income and multiply times 50%. So 10,000 times 50 is $5,000. That's the magic number. That's the most debt you're allowed to have, including the new rental property payment, your existing primary house payment, if you have one, all of your monthly debts, car note, car lease, student loan payment, personal loan, any loan that you may have co-signed for a family member on to help them out, and all of your minimum credit card payments. Don't forget the department store cards. So when you add all those up, you subtract from, so you got $10,000 times 50%. That's $5,000. Let's say you've been very frugal with your money. You've been very cautious. You're driving a used car. You're cutting your own grass, and you just don't have a lot of expenses. In fact, the only expense you have is a $2,500 house payment. Now, for those of you that are calculating this, remember that your house payment is PITI, P-I-T-I. Don't forget, it's principal and interest, it's the property taxes, and the homeowner's insurance on your primary residence. So if you're a non-escrowed borrower, don't just count the principal and interest. You got to go and add in the taxes and insurance and HOA fee if you're in a subdivision or a condominium. Okay, so back to our formula. $10,000 monthly gross income times 50%. Max debt for everything is $5,000. You have a $2,500 house payment, and you've been really good and have no other debt. That leaves you $2,500 for your rental property. Okay? So when I do your pre-approval, I'm going to be backing into that number and figuring how much mortgage is $2,500 if you're comfortable going to $2,500. You may say, Alene, I don't want a mortgage payment more than $2,000. Well, then we back into $2,000. Remember that the $2,000, if that's your comfort level for your first rental property, needs to include principal and interest. So that's the repayment of the mortgage, taxes, homeowner's insurance, or in your case, it's going to be renter's insurance, and an HOA fee or condo fee if it's got an association fee. And so let's say that when we back into it, $2,000 ends up being a $300,000 loan. All right, so now you're a $300,000 loan. Now we got to do the reverse math. Remember, you need 20% down payment. That's the minimum. You can always put more, but that's the minimum. So you would take 300,000 divided by 80%, and we kind of reverse math it and put you at a sales price of $375,000. So that then becomes your maximum sales price for your rental property. Now, there's a lot of people who go online and do a lot of searches and try to find a rental property, for $375,000. My recommendation after doing this for so many years is get pre-approved by an experienced lender and then work with a professional realtor, someone that is full-time, that does this not just on the weekends when they have a few hours to fit in a real estate transaction, but a full-time realtor who can help and work with you and show you different neighborhoods and show you different areas that offer a $375,000 house. And again, this is just one example. Okay. And that's a little bit about debt to income, how we calculate it. So if you're already writing some numbers down and looking at your numbers and saying, okay, I got my $10,000 income, 50%, I got a $2,500 house note, I got a $500 car note, I got $500 in student loan debt, and I got 5 credit cards with a $50 payment, and your number's down to $10, that's your max house payment you qualify for. So as you're looking at your numbers, you need to probably look and say, what debts can I eliminate? And maybe rather than putting money aside to save for a down payment, you need to focus on reducing your debt. And that's kind of why how Brenton and I work together to kind of structure it, because it's hard to do 100 examples on a podcast like this. But of course, when I talk to you and then you talk to Brenton, we can customize some ideas for you. Okay. Let's talk a little bit about managing the property and whether or not you want to do it yourself or do you want to hire someone. So you have options, and that's the good thing. And you could always try it yourself. And if you don't like managing it yourself, you can always turn it over to a property manager. So let's talk a little bit about how property management works. Well, basically, they're going to collect the rents for you. They're going to probably help you screen the tenants and kind of find out if the tenant pays their bills on time. They're going to do the interview process. They might pull the credit for the tenant and then tell you, hey, I found a really good tenant. They make good income, they got good credit, and they help you sign a lease, and you're done. And the next thing you do is the rent check comes in. Let's say the check is $1,000 for rent. Guess what the property manager does? They get your $1,000 and they keep a portion of that for doing their portion of the job. But their typical fees are run from 10 to 15%. That's kind of the average that we see. Now, there are exceptions. There are companies that charge as much as 25%, but they're generally providing more services for you and for your tenant. So using the average of about 10 to 15%, when that $1,000 check comes in and they charge 10%, they're going to withhold $100 and they're going to deposit into your checking account $900. But now you have no hassle. You don't have to call the tenant when they don't pay. You don't have to take an application and screen their credit and verify employment. You don't have to pull credit. You don't have to call them when they don't make a payment because you both are busy at work. You don't have to do that. That's all taken care of by the property management company. So if you want to be hands-off, that's the way to go. Now, on the other hand, you can do what's called self-manage. And self-manage is kind of what my husband and I do. Being in the rental property business for 33 years, I've actually don't have any of our rental properties in Tennessee through a property management company. So what does that mean? Well, it's a lot of responsibility, but it doesn't take that long to get up to speed. There are classes you can take for landlords. If you want to jot this down, there's a great website you can just check out. Their acronym is NAIL, N-A-I-L. NAIL stands for National Association of Independent Landlords. So when you self-manage, you're considered an independent landlord like myself. NAIL is a great, great provider. I use their leases. I use their helpful tips for collections if I do have to make a collection. What I love about NAIL is the ability to become a member, and they will screen you as a landlord. And they will, with a small fee, I believe the annual fee is like $68 a year. And with that, you get to pull 2 credit reports for free. So if I only have 2 move-outs in a year, basically my membership pays for the credit report. But what NAIL allows you to do is from home, and again, they're going to verify that you are a certified lender. They'll want your ID. They want to know that your home has a shredder so you can shred the application, and that you're they're basically checking out that you're valid. So once I get the application from the tenant, I'll enter it in on the NAIL application, put my membership fee in there, and they will actually pull credit for me through one source. They pull it generally from Equifax, and then I order for all my tenants, all of them, regardless of how nice they seem, what their age is, no matter what, I always order a criminal background check. And I would highly, highly recommend this. You'd be surprised what you find out. Even though it's on the application, and I ask if you've ever had anything, you'd be amazed how many people lied. So I pull a credit report, and then I also pull the criminal background check. Now, being a mortgage lender for many years, I have what I call my mortgage hat. And when I'm a landlord, I look at those credit reports with a landlord hat. And what exactly do I mean by that? Well, as a mortgage lender, I've got to have a 720 score. I got to have a DTI at a certain number. They've got to have so many active trade lines on their report. When I'm looking at a tenant, I'm looking to make sure there aren't any collections for things like the basic necessities like water, utilities, their car note. So when I see collections for the water company and electricity, that is a big red flag, basically telling me these folks cannot even afford to pay and have not in the past been able to pay their utility bills. The second thing I'll see, if I see a landlord collection on there for back rent, well, you know that's an automatic decline. Like, they always have a story. And let me tell you, in 33 years of owning rental property, I know every story. I know every story. And it's never their fault. It's always somebody else's fault. It's their parents, it's their spouse, it's a divorce, it was the job, it was the dog. You name it, they came up with it. So again, when you're looking at the credit report, and if I work with you on the rental, I'd be glad to help you with this, just kind of a nice little tutorial in the beginning, and you'll quickly figure it out. So we're basically looking for, they don't have to have a 720. I'm looking for good payment history. Do the bills that they have, are they being paid on time? And that's really the most important thing, because when you become a landlord, the number one thing you want to happen is what? You want that rent payment on time. It's due on the 1st. I let my tenants pay till the 5th, as long as they send me a notice as to why. And I start charging a late fee on the 6th. And the late fee I usually charge is 5% of the rent amount. So when it comes to financing rental properties, we can finance condominiums, can finance single family homes, duplex, triplex, and a quad, and that's the limit. Once the property exceeds 4 units, then you're going to have to look for a commercial loan. Because in the lender world, all the typical banks, all of our investors are all going to limit the number of units to 4. So if you're looking at an 8-family, you're looking at an apartment building that's got 30 units in it, that is going to be a commercial loan and will require typically a larger down payment, probably 25 to 30% down payment, and a commercial loan. Which, by the way, on a commercial loan, those type of loans can be structured as a corporation, as an LLC, and they don't necessarily have to be in an individual name. Flip back to financing a rental property, and remember the max is 10. So I get a lot of customers will say, you know, I'm buying my second rental property and I want to form an LLC, a limited liability corporation. How do I do that? Well, the bad news is lenders do not allow you to finance a 1 through 4 family in the name of anything beside your personal name. Okay, so again, if you're financing a rental property through a lender, they will only do the loan in your personal name. So if it's individual name only, husband and wife, you are taking personal responsibility for a personal mortgage. And it's got to be a residential mortgage. When I say residential, I mean there are some neighborhoods that have popped up in Atlanta and even in Nashville that are considered mixed use. I'll give you an example. For those that live in Nashville, Berry Hill off of Thompson Lane, that used to be a residential neighborhood, all with little single family homes. And over the past 25 years, almost every one of them, I think except 2, have converted to office buildings. Attorneys who have opened up, title companies, law firms, real estate companies. So it's no longer a residential neighborhood, even though when you walk through or drive through the neighborhood, every single house there looks like a residential house, which it is. It's a single family home. But those are more difficult to finance. Like a typical lender like myself cannot finance it if it's considered mixed use. So working with a realtor, most full-time realtors will be well aware of this, and they're going to come in a neighborhood and say, oh, this looks like a neighborhood, but this is a mixed use neighborhood. And if you wanted to finance something there, you would have to get a commercial loan. Okay. Just an FYI, I have commercial lenders on the same floor with me in our office, and most commercial lenders won't touch anything like under $400,000 or $500,000. So if it's a little $100,000 mixed use house that you want to finance, it is just more difficult to find a lender to be able to do those type of loans. So my recommendation is look for something that's more kind of fit in the box, unless you're paying cash. And that's usually who ends up buying those type of homes are cash buyers because they can't get financing. So that's a little bit about number of properties, types of properties. I don't know if there's any of you out there that are thinking about buying a condominium as an investment property. There are so many rules about financing condos, but I would like to share with you just a few of them. And one of them is, when you purchase it as your primary residence, there is a lot less rules, but we're talking about buying a condominium as an investment property. When you are purchasing a condominium as a rental property, there are lots and lots of rules. One of the very first rules is that I think of all we call it the project, out of all the units that are in the condominium, less than 50% can be rental property. Okay, so let's do an example. The condominium project, you're interested in buying a condo and then there's only 10 units. and you find out through your realtor that 7 of them are already rental units. So you purchasing unit number 8 and making it a rental property, it makes it 80% rental units. Can't get financing. Okay, so real important when you're working with a realtor and you're looking at condominiums, have them call me, or whichever lender you're going to work with, have them talk to the lender, because there are a lot of hard and fast rules. I call them gotchas. I'll have a customer very excited, found a condo and it's near a university. And years ago, that may have been owner occupied, but close to the university, those are snatched up and rented out to college students, people that are in undergrad, people that are in graduate school, and they've all been snatched up as rental property condos. So just keep an eye on that. Also, if the condominium itself with the homeowners association has a lawsuit pending, cannot get a mortgage. So there can be no pending litigation on that condominium if you're trying to get a loan. And there's lots of examples I can give. I'm not going to go through it, but if you've got questions, certainly talk to me about that. Okay.
Alene, that actually leads into a couple questions, because we do need to close up, but we had a couple questions.
Okay.
One of the questions was, I know that you said that you can finance the properties and it has to be under your name if it's less than 4. But one question that we had was, now that you have so many, are they still under your name or do you have them under an LLC?
Okay, that's a great question, and I will just share a personal story. So we've been married, like I said, 33 years and been doing rental properties. So we have kept it, all of them in our personal name, but we've also kept the number of finance units under the 10, so that we haven't had to, some of our loans were only 15 years, so we paid off the loans. So some of the loans that we had are already paid off. So kind of right now we're kind of in a position where most of our rental properties have been paid off, but we're keeping them in our personal name. Now, mostly because it's just difficult to find financing in the name of a corporation or an LLC. But I'm not saying there aren't any lenders out there. I'm just saying I think you'll find it difficult to find someone to finance personal property in a business or LLC name. Did I answer that question?
You did, and I think part of the concern was liability. So in future years, if one tenant chooses to sue you, is it possible to maybe put the deed of the house in the name of an LLC after the fact? If so, is that something that you recommend? That's part of the question.
Okay, that's a good question, fair question. So most, we call it the note that you sign when you take out a mortgage. We'll say that you can make no changes to the title or the deed to the house, which is the ownership part. So we do not allow, at Synovus and most lenders don't allow you to get a loan in an individual name, but put the ownership or the deed in the name of an LLC. And the note prohibits you from transferring or doing what we call a quit claim deed from your individual name into the LLC. Now, if you do it, it's kind of done at your own risk, because if the lender finds out that you transferred the ownership, which we'll call that the title or the deed, to your house into the name of an LLC, if the lender finds out, which they spot check and they do auditing, if they find out, it'll be what they call a due on sale. I mean, it'll be a forced requirement to pay that loan off because it was not approved on the beginning. The note does say that you have to make any changes. You have to present changes to the servicing company to get approval, but I've never had anyone get approval to transfer a personal mortgage ownership piece, the title, into an LLC. Okay. So what you want to do is talk to your insurance agent about having good insurance on the property, liability insurance, coverage against lawsuits, and also, and I don't know, Brenton, if you offer this, but we also have what is it called? I just forgot the name of it, not balloon insurance.
Umbrella coverage.
Thank you. Umbrella policy. I was like, balloon umbrella. Yeah. And we have a $2 million umbrella policy. So that would cover anything over and beyond what is already insured just through the regular renter's policy.
Yeah, and
I
I'll
might
get
say
to
yes.
I'll get to the second question, but before
Okay.
we do, one thing when you have to get umbrella coverage, you actually have to have, for most insurance companies, the max of your homeowner's insurance or property and casualty insurance before they'll let you get that umbrella policy. Some companies may be different, but just if you're getting an umbrella policy, you might find out that you actually have to increase your coverage with your underlying policy to get that umbrella policy. Not all companies do it, but that's just something to be aware of if you have a company that does. And then the last question that we had, Alene, before we close up was, do you have one main bank account for all of your rentals, or do you keep them in the cash flow in separate accounts?
Oh, great question. Okay. So I actually have two accounts. One that we just run kind of like our personal banking through, and then at Synovus, I have a second account that's exclusively for all of our rentals. So I put all of our rental deposits in there. I pay all the taxes through that account, the insurance, the HOA fees, all our handyman, grass cutters, everybody is paid through that one account. It makes it a lot easier for preparing taxes at the end of the year. Some of you might do it on your computer, some use the old-fashioned checkbook, but just it's a whole lot easier if you have one separate account for running all your checking account, your rental properties through. That's a great question. And by the way, you don't have to have a business account. This can all just be a personal account, because remember, your loans are all in your personal name.
Perfect, perfect. Well, Alene, I want to thank you for all of your expertise and for sharing with us. As you know, if you're watching the call live, first off, thank you for joining us. We are going to have this replay made available for you. We're going to edit it to knock out the first few minutes where Alene and I were just catching up on stuff, but we'll also share a summary of just some notes that I've been taking as you've been talking, Alene. So thank you very much.
Oh, you're welcome. Thank you.
If you would like to contact Alene directly, we will also put her contact information in that recap email. And we want to thank you guys for joining us. And Alene, thank you for sharing.
Thank you. Bye, everyone.
Bye. Have a good one.
Thanks, Brenton.